Hey everybody, welcome to your weekend review for the week of Monday, June 26th, 2023. And oh, what a week it was. MBS were pretty much flat on the open, stocks too, only up like 6 points. Bonds were stronger in the overnight session, with most of the gains following a risk-off trade in Europe, lower stock prices and lower bond yields. U.S. traders initially bought the rally at the 820 CME Open, but that didn't last long. Volume and selling momentum picked up at 9 a.m. and pretty much erased the gains quickly. Jerome Powell's comments last week pretty much stuck the fork in any bets of rate cuts this year. While the comments didn't impact the July futures all that much, the December futures now predict that the Fed funds rate at the end of the year will be 25 basis points higher than it is now. Interestingly, they are not predicting two hikes like the dot plots have predicted the last two times around. Not sure what's up with that. It wasn't that long ago that the futures were handicapping in a Fed funds rate of about 4.5. The Fed has instituted a drastic tightening policy, the likes of which we haven't seen in 40 years. Historically, tacking on 500 basis points of tightening would cause a recession, and we simply haven't seen one yet. Reprice risk on the day was low. No economic effects really, other than two-year auction in the afternoon, and no real Fed speakers or anything like that. We did get news that bank deposits rose by $17.6 billion last week after dropping $78 billion the week before, which is a good sign that could result in less bank bond selling because the banks won't have to sell off bonds in order to refund deposits. It was an uneventful, boring, uninspiring, unenlightening summertime Monday in the bond market. Kind that would have been far better in the construction of another 3-day weekend. Alas, it happened, barely. And that leaves us with the unpleasant task of finding anything meaningful to observe. Such days reduce the analysis to focusing on technicals and bigger picture themes. On technical front, the 10s battled the 3.72 range floor yet again, but failed to maintain any breakout. The other day, MBS were up 5 basis points at 99.95. Stocks lost about 20 points. But at 99.95, we are looking at those technicals again, so we're pivoting right around that Fibonacci S1 retracement at 99.845, which has posed to be a pretty strong one, and everything is converging upon it now with ranges narrowing above and a new Fibonacci below. So we should see some stability, which is kind of nice, but those looking for way lower rates are going to be pretty disappointed for a while.